Welcome, market participants, to another Three Things in Credit. I'm Van Hesser, Chief Strategist at KBRA. Each week, we bring you three things impacting credit markets that we think you should know about. I admit to being a bit taken aback by a recent comment coming out of Oaktree's Howard Marks, where he said the outlook is as unpredictable as ever, if not more so, unquote. He made the comment in response to client feedback. Mr. Marks said, and I quote, "Most of the people he speaks with tell him they're unusually uncertain about what lies ahead in terms of the economy, central bank behavior, fiscal management, politics, and geopolitics," unquote. I get it. There's a lot to think about. I guess I'm more in the camp of the authors of Oaktree's latest Insights piece, who acknowledge that the economic and corporate fundamentals remain healthy. I guess Mr. Marks' point is that there is the potential, lots of potential, changes coming on the economic, geopolitical, and market structure fronts. Something to look forward to. All right, this week our three things are: 1, good things coming to an end. We're still not normal, but we're headed there. 2, bankruptcy trends. A recent shift in trend is noteworthy. And 3, thresholds. Things that, when crossed, shift sentiment. All right, let's dig a bit deeper. Good things coming to an end. Nothing I can think of has rocked the economics intelligentsia more than the durability of the U.S. economy over the past year or so. Tightened monetary conditions at the most dramatic rate in 40 years, and the stimulus-driven economic frenzy must, the thinking goes, grind to a halt. And because monetary tightening is the bluntest of blunt instruments, and the incentive for credibility-obsessed central bankers is to naturally overshoot, a recession must surely follow, right? Well, instead, the U.S. is growing well above potential despite the rate and QT shock. And now comes, sadly, the predictable. Alternative narratives of no landing. One particularly memorable rant stuck with me, this from one of the highest profile strategists. There is not one shred of evidence that monetary tightening is impacting the economy. Wow, identify the elite in the room. Now, cooler heads with a broader perspective know there is plenty of evidence, hard evidence of slowing. Take housing, not house prices, but the economic activity that goes with a healthy and active housing market. Really, take any interest-sensitive sector. Take small business, where a cyclical high of 40% of firms are unprofitable and where half of America is employed. Take lower-income consumers, where inflation bites hardest. Trust me, they're not excited about disinflation. They need deflation. And, needless to say, they have not participated in the household net worth surge driven by soaring residential real estate and stock markets. So there has been slowing. It's just been more than offset by extraordinary growth. So the question now, of course, is just how durable is that extraordinary growth? Because in the Fed's case, you know it is going to continue to favor the breaking inflation part of its dual mandate. Chair Powell said as much this week. From a macro standpoint, we are seeing a contraction, really a correction, in M2, the money supply. All that stimulus created a stunning bubble in M2, some 25% above trend in December 2021, according to our good friends over at Deutsche Bank. Well, it's now down to 6% above trend and is expected to return to trend by year end. This is a big part of the support for that extraordinary growth we've seen in 2023 and 2024. In particular, we see it in excess savings, which has proven to be much more durable than was initially estimated. A more reliable measure has been actual deposits at Bank of America, which are still elevated at roughly 130% of pre-pandemic levels, but something that is clearly coming down. The macro folks over at Deutsche Bank have excess savings running out by year end. And if we look to B of A's data on consumer spending, growth has already hit a wall, which does confirm that most of whatever excess savings is left is with higher income folks who are increasingly less inclined to spend. We see that in the latest consumer confidence data from the Conference Board. So, pulling all of this together, the benefits of stimulus figure to finally run out by Q4 2024. There is room to run for growth, but it is slowing, and we don't believe we'll end up in recession. Ironically, a gradual slowdown in 2024 reduces the potential of a hard landing in 2025 under the weight of higher for longer. And finally, Don't overlook what's happening in small business and lower income consumers. It's not pretty, and it matters. All that good stimulus is quickly fading. All right, on to our second thing, bankruptcy trends. And we've been watching closely bankruptcy data, both at the consumer and commercial sector levels, for obvious reasons. And the data was increasingly worrisome. On the commercial side, the year-over-year growth in business bankruptcies historically correlates closely with year-over-year growth in real GDP. And the bankruptcy data in the fourth quarter of 2023 was not good, up 85% from Q4 2022 to the highest level since 2012. This kind of rise is not consistent with growth, in fact, just the opposite. Increases of this magnitude are typically seen only in recession. But then something interesting happened. Bankruptcies in the first quarter of 2024 fell by a material amount, 33% sequentially. Filings were flat to the year-ago level, and the latest data is consistent with, ready for it, 2+% growth. What's changed? Well, digging into the soft landing narrative, you find that financial conditions have eased, meaning financing, the kind of financing that can keep a struggling business alive, was more easily accessed. Another reminder that we are not falling off a cliff. Now, over on the consumer side, there's similar benign news. Quarterly bankruptcies are 17% higher than the pandemic-era lows, but running at about half the rate we saw back in 2018 and 19. You might think that is attributable to the unusually tight jobs market, but we had that back in 2018 and 19 as well. Wages are higher and household net worth, including the aforementioned excess savings phenomena, has soared, which probably explains a lot, something we see in the consumer's historically low financial obligations ratio. In any event, well-behaved bankruptcy filings are another reminder that the soft landing scenario, at least for now, is playing out. All right, on to our third thing. Thresholds. As we gamely march on through these unusually uncertain times, we often think of tripwires. What data thresholds need to be crossed in order to think different, to borrow one of Adlan's more wretched taglines? It's worth mentioning that we've crossed some of what many thought were red lines, only to find muted market or economic reactions. Things like a negative yield curve, or a decidedly negative trend in the Conference Board's leading economic indicators. Even Claudia Sahm has weighed in on her Sahm rule recession indicator, saying this time might be different. In any event, here are a few thresholds we think are worth watching. Non-farm payrolls below 100,000. The most obvious byproduct of above potential growth is the job growth supporting it. We dipped below this threshold twice in 2023, in March and October. The last time it was negative was December of 2020. Market sensitivity, well, depends. It could be bad news as good news, i.e., bring on the cuts, or bad news as bad news. In this case, we think markets would lean more toward risk on, as in the cuts are finally here. Second one, oil greater than $100. Generally not good for markets. It serves as a tax on consumers. Remember, gas above $4 a gallon weighs on consumer sentiment. Margin pressure on businesses, and, in all probability, an indication of escalating geopolitical tensions. None of that is welcome. How about the 10-year, above 5%? Interest-sensitive industries, housing, capital goods would continue to be impacted, as would levered consumers and businesses. Long-duration asset valuations, think growth stocks and commercial real estate, would suffer. And financiers have to go back to their drawing boards. Deals that worked in a low rate with cuts expected environment have to get redone, and not all will work under a higher cost of capital. This would not be good. And finally, the CPI supercore month-on-month, less than 0.4%. Services inflation ex shelter, the most labor-intensive measure of inflation, the path to monetary easing. Eventually, we'll get there. Hopefully, it won't be at the end of a central bank policy error. So there you have it. 3 things in credit. 1, good things coming to an end. Normal didn't feel all that good in 2019. Maybe we're headed back to that. 2, bankruptcy trends. All in all, pretty well behaved. And 3, thresholds. Keep an eye on that 10-year. As always, thanks for joining. Don't forget to check in on kbra.com for our ratings reports and our latest research. We'll see you next week. Hello, listeners. Join me, Van Hesser, KBRA's chief strategist, for in-depth conversations with credit experts in my new monthly podcast, Leading Voices in Credit, where I'll interview market professionals on the latest trends in credit markets. That's Leading Voices in Credit with Van Hesser. Subscribe now.